Silver is everywhere right now. Most of it is adrenaline. So let's do the boring thing, the useful thing. Because the real story isn't a villain, it's a mechanism. And the mechanism always lands in the same place, on your bill, on your rate, on your savings. Yes, silver just made headlines again. And yes, it's been trading in the low to mid 60s per ounce this week. That's the noise layer. Here's the signal layer. The signal is the split: paper price, physical reality. To understand that split, you need two rooms: this room and this room. COMEX, LBMA. COMEX is the American futures machine, not a vault, a contract factory. A futures contract is simple. It's a promise with terms: quantity, quality, delivery rules. In theory, that promise can end in metal. In practice, it usually ends in someone closing the position and moving on. This is what futures are for: hedging, inventory planning, risk transfer, miners hedge, manufacturers hedge, banks hedge. It's plumbing. The futures price is supposed to be the public signal: one number, one reference point. But here's the part nobody explains. That number is not the price of silver. It's the price of a very specific kind of paper promise. LBMA is different. London is mostly an over-the-counter market. A lot of what trades there isn't bars moving. It's claims, balances, allocations. It's a ledger world. And ledger worlds behave differently under stress. Now we go to the part that actually matters: warehouses, not vibes, labels. COMEX reports two big categories of silver in approved warehouses: eligible, registered. Registered has a warrant attached, meaning it's eligible metal that has been put on the deliverable shelf. Eligible means the bar meets the contract specs, but no warrant has been issued. Here's the kicker: eligible is not the same as available. Eligible can be somebody else's property, sitting there, not for you. So the label matters, because the label tells you what the exchange can deliver and what it can't. And right now, that label line is the whole story. As of the CME's December 11th, 2025 warehouse report, registered silver was about 137.6 million ounces. Eligible was about 315.8 million, combined about 453.4 million. Now don't mishear that. That combined number doesn't mean that's what will show up. It means that's what is sitting in approved buildings. The exchange itself says this, in plain language: deliverable supply is an estimate, and not all eligible is assumed to be readily available. In fact, when COMEX estimated deliverable supply, it applied a 50% discount to eligible stocks for conservatism. So when someone waves total ounces at you, you should hear some of that is a mirage. Because the real stress doesn't show up on a chart first. It shows up at the counter. This is where the story pivots. The paper price can be one thing, and the physical premium can quietly become another. You've seen it in headlines: premiums flaring in places where the metal is actually being bought and used. Sometimes the metal moves by air, because time becomes part of the price. And suddenly, the price isn't just price. It's logistics, verification, insurance, paperwork. You can't meme your way around assay. You can't likes your way around fabrication. Physical has friction. Paper is fast. Physical takes time. And when time matters, trust matters. So you get the disconnect. Not because someone flipped an evil switch, but because the contract and the bar are two different products. Spot is one input. The bar you can hold is a different pipeline. And pipelines choke in predictable ways. Here's the part nobody explains. When industry needs silver, it doesn't care about your chart. It cares about delivery windows. It cares about certainty. Industrial demand is the quiet heavyweight: solar, electronics, grid infrastructure. Silver is small inside your life, but it's everywhere, in the parts you can't replace with vibes. And when that industrial pull meets constrained supply, the first thing that moves is not always price. The first thing that moves is availability. Paper markets are designed to settle. They are designed to net out. They are designed to keep the machine liquid. That's not corruption. That's design. It's efficient until efficiency becomes fragility. Because the big story isn't silver, it's trust. trust in settlement, trust in promises, trust in the idea that paper equals thing. If you want a clean example of why trust can crack, look at what happens when reserves become political. The EU and partners have publicly said around 300 billion euros of Russian central bank reserves are blocked. When that happens, every finance ministry on earth takes notes. Not because they love drama, because they love survivability. This is the pattern. In calm times, promises trade like things. In stressed times, things trade like things. And yes, this reaches you, because your pension is mostly promises. Your bank balance is mostly a ledger. Your stability depends on settlement. So when you see a paper physical split, don't watch it like a lottery ticket. Watch it like a stress test. Registered is the metal wearing a delivery badge. Eligible is the metal in the building with its hands in its pockets. And those badges can change. Metal moves categories. Warrants get issued. Warrants get canceled. That is the gearbox, which means the most important question is never how much silver exists. It's how much silver is being offered. Because in the real world, liquidity is unequal. Some people can always buy. Most people just watch. So we're not doing buy silver. We're doing read the signal, because signals tell you what systems won't say out loud. According to the Silver Institute and Metals Focus, the silver market ran a 148.9 million ounce structural deficit in 2024, and the combined deficit from 2021 to 2024 reached 678 million ounces. That's the supply math, not a spreadsheet, a bathtub. If more leaves than enters, the level falls. And silver has an extra problem. A lot of it is mined as a byproduct, so supply doesn't surge just because price screams. It lags. Meanwhile, demand doesn't ask permission. It just shows up as orders, production runs, contracts. Industrial demand isn't emotional, it's scheduled, and that's why it drains inventory quietly. This is where the system gets honest. When inventory becomes tight, everything else becomes language. Premiums, delivery times, sourcing routes. Even Reuters has described episodes of physical tightness and metal moving across regions to ease spot market strain. Which means the story you're watching is not mystical. It's inventory management under pressure. It's claims competing with uses. So here's the clean takeaway for part one. COMEX prices paper promises. LBMA clears large pools of claims and allocations. And warehouses translate the abstract into something deliverable. That's why the internet gets this wrong. It wants a villain. But the villain is usually just incentive. Leverage wants liquidity. Industry wants certainty. Paper and physical can trade together for years. And then, quietly, they don't. That's the first crack. Part two is where the story stops being markets and becomes math. Not a spreadsheet, a bathtub. If more leaves than enters, the level falls. That's not opinion, that's gravity. A deficit is just a fancy word for inventory doing the work. The Silver Institute's World Silver Survey shows a structural market deficit of 148.9 million ounces in 2024. And it wasn't a one-off. It was the fourth consecutive annual deficit. Over 2021-2024, the combined deficit totaled 678 million ounces. That's the pattern. You can run a system on stored buffers until the buffer becomes the system. Now here's the part nobody explains. Silver supply doesn't behave like silver demand. A lot of silver is mined as a byproduct of other metals, copper, lead, zinc. So if silver demand spikes, you can't just turn on silver mines overnight, because the mine is chasing copper economics. New supply is slow. Permits, equipment, labor, refining, time. Demand isn't slow. Demand is scheduled. Industrial users don't buy feelings. They buy throughput. Silver industrial demand reached a record 680.5 million ounces in 2024. This is why silver is different. It's not just investment metal, it's an ingredient, and ingredients get consumed. When ingredients get tight, your life gets expensive in quiet ways. Repairs, parts, downtime. This is where the bathtub becomes visible. Not on CNBC, in procurement calls at 7 a.m., because silver isn't one thing. It's forms, bars, grain, powder, industrial paste, and form is friction. You can't install a futures contract into a solar panel. You need processed material on time. So when headlines scream plenty of inventory, remember what they're actually counting. Approved warehouses, eligible bars, theoretical availability. On the CME's Silver Stock Report for activity date December 11, 2025, total registered was about 137.58 million ounces, eligible about 315.78 million, combined about 453.36 million. Now the important sentence. Eligible is not for sale. Eligible is meet spec. That's all. CME's own filings define eligible as metal that meets specs with no warrant issued and registered as eligible metal with a warrant. A warrant is a choice to place metal on the deliverable shelf or to pull it off. And COMEX itself has described discounting eligible inventory when estimating deliverable supply. So here's the mechanism, clean. Paper can stay liquid while physical gets tight because the system is designed to settle. Netting, offsets, cash equivalents. That design is not evil, it's efficient, until efficiency becomes dependence. And when dependence shows up, it shows up as cost. Your mortgage rate, your refinancing window, your credit tightening. Now zoom out. Why is this happening now? Why is the bathtub draining now? Because trust has been taking hits in public, not theories, public policy, frozen assets, rule changes, payment rails turning political. EU and G7 immobilized Russian sovereign assets have been estimated around 260 billion euros, with worldwide immobilized assets possibly nearing 300 billion euros, per European Parliament research. And in Europe, the debate has centered on roughly 210 billion euros of Russian assets held in the EU, much of it at Euroclear. If you run a country, you see that and you don't think headline, you think precedent, you think counterparty risk. This is where nations come in, not because they're prophets, because they're managers of survival. Russia is the clearest case. Study in the narrative shift, not just gold. Silver is now being talked about in the same sentence as strategic reserves, according to multiple reports tied to Russia's budget and policy discussions. Even mainstream commentary has noted that Russia's central bank signaled intent to add silver, though details and follow-through are opaque. And that uncertainty matters, because the point isn't how many ounces. The point is that the category changed. Silver moved from industrial input to strategic consideration. Now look at China. China produces a lot of silver and still imports silver. Because production volume isn't the same thing as available form at the right purity in the right place. China's reported silver production in 2024 was about 3,300 metric tons. China also imported large amounts of silver ores and concentrates in 2024, reflecting ongoing import reliance in parts of the supply chain. That's not hype, that's industrial reality. When your economy runs on manufacturing, you secure inputs, even if you produce them. And you don't feel that as China importing, you feel it as supply chains that stop being cheap. Phones, cars, solar, grid upgrades, everything with metal in it. Now India. India is one of the world's largest silver consumers, and when India buys, it buys physically. LBMA noted that in the first 2 months of 2024, India's silver imports surged to a record 2,932 tons. Reuters reported India's 2024 import spike and the way demand drew down stocks, pulling imports back in 2025. This is the part nobody explains. Imports are not just demand. Imports are a decision to convert money into metal. Not exposure, not an ETF line item, metal. And yes, ETFs matter, but the system's signal is clearer than that. It's where physical flows go when pressure rises. As of December 15th, 2025, Reuters reported silver around $63 per ounce after recently hitting a record high. Price is loud. Flow is honest. When metal starts moving by urgency, that's not a price story. That's a trust story. Now we connect it back to London, because London is where global precious metals clearing has historically concentrated. And concentration is a strength until it becomes a single point of sensitivity. This is why the paper physical split matters. It's not silver going up. It's settlement credibility being tested. You don't live in markets. You live in settlement. You live in whether the promise turns into the thing, in time, at the cost you expected. The same pattern shows up everywhere. When systems get stressed, the invisible fee becomes visible. Premiums, spreads, delays, paperwork. That's the drain pattern, not conspiracy. Incentives. Paper smooths volatility. Physical exposes it. And under stress, physical speaks first. So what does it mean for you? Not buy silver, not sell everything. It means you start reading the world correctly. When paper markets disconnect from physical reality, you're watching a trust. Migration. From claim to possession. And that migration happens before the popular story catches up, because headlines follow price. Systems follow risk. Institutions don't wake up and believe in silver. They wake up and fear fragility. They diversify. They shorten chains. They demand collateral that doesn't depend on a third party's mood. The point is not collapse. The point is load. How much stress can the bridge take before the cracks become policy? Because your life is downstream of this. Your pension is promises. Your mortgage is a promise. Your paycheck clears through promises. So when you see a paper/physical split, don't watch it like a trade. Watch it like a warning light. Not doom, a diagnostic. A warning light doesn't tell you the car will explode. It tells you the system is compensating, and compensation has limits. This is why the silver story spreads so fast. Not because people love metal, because people don't love fragility. They don't love being priced out of basics. They don't love watching savings lag behind costs. You're not watching a price rally. You're watching trust move from paper to physical. That migration has a direction, and direction matters more than price. So the uncomfortable question isn't how high can it go? It's how many parts of your life still assume the paper always becomes the thing, on time, no questions asked.